Okay, so we're here in Brightspace. Right, well, if I can get it to scroll, there we go. So where I am is under Chapter 2 Resources, okay? This, personally, I think this is a really great document to print out. So again, this accounting cycle document, just keep in mind that in the accounting department on a daily basis, the only thing that we are doing is collecting cash, and then we have to record, an increase in cash, and then we have to record what was that cash receipt for, okay? Where did it come from? Then we've got cash disbursements. So again, you're going to reduce cash, and then you have to designate what was that cash disbursement for. Then we're going to bill customers. So that one is super easy because it's the same thing every single time. The only difference is we have to determine whether it's sales or service revenue. And you remember, what's the difference? Sales revenue, we're selling goods and products. Service revenue, we're selling time. Okay? Then number 4, we're recording invoices from vendors. So now this is where we bought something from somebody else, whether it be product or time, and we put it on account. So when they finished up, we said bill us for it, or put it on my tab. So we have to record the amount owed, and then we have to record what it was for. Okay. So most of that was in Chapter 2. Most folks don't have many problems with Chapter 2. Because everything in Chapter 2 is all on the balance sheet. Okay, so remember the balance sheet equation is assets equal liabilities plus owner's equity, or ALO. Okay, assets are on the left-hand side of the equal sign, so they go up on the left, down on the right. Liabilities and equity are on the right-hand side of the equal sign, so they go up on the right and down on the left. Okay, and again, don't make this hard. We're just simply taking what you're used to in math class of a single columnar format. We're switching it into a 2 columnar format where all the adds go on one side, all the subtracts go on the other, and it just depends on what type of account it is as to whether or not it is an add or subtract on the right or the left. Don't go there on that whole thing. I've mentioned this before. Don't go there on that whole thing of thinking that, debit means subtract and credit means add. It does not. It means right and left. Okay, so don't miss that one. Let's see. So there's that one. Then so that's up a nice little review up through Chapter 2. Then when we get into Chapter 3, we start adding things that most folks end up finding slightly more difficult. The only thing that we're doing, though, in Chapter 3 is, if I can find my eraser, there we go. The only thing that we're adding in Chapter 3 is down here underneath the owner's equity piece of the puzzle. Hang on. All right, so we're going to throw it out here to the side, but just remember that all we're doing in this scenario is we are adding 3 additional accounts, all of which are under owner's equity. And just realize, remember, owner's equity, there's 2 big pieces to owner's equity. You have retained earnings and you have common stock. Okay, those are the 2 big pieces. These 3 accounts that we're adding in Chapter 3 are simply those accounts that affect retained earnings. Okay, and if you go back to Chapter 1, remember that we start with the income statement, which is revenues minus expenses equals net income, right? Then we pulled net income into the retained earnings statement. So again, that retained earnings statement is what we're talking about right here, okay? So all throughout the year, the only balance that you're going to see in the retained earnings account is the beginning retained earnings, okay? And then everything that's affecting retained earnings, like revenues, expenses, and dividends, are all going to be recorded separately. So the three accounts that we're adding in Chapter 3 are revenues, expenses, and dividends. Okay? Now, when you're thinking about debits and credits, when it comes to revenues, expenses, and dividends, you have to think about how a change in those accounts affects retained earnings. So, for instance, try to picture that income statement. Holding everything else steady, if we increase revenues, that means that net income goes up or down. It goes up, which then means if net income increases, when we pull net income over to the retained earnings statement, that means the ending retained earnings is also going to go up. Okay? So, notice what's happening here. When we're talking about revenues, since revenues function the same, and as revenues go up, retained earnings goes up, then revenues are also going to go up on the right-hand side. Okay? When we're talking about expenses, holding everything else steady, if expenses go up, what happens to net income? Good. It goes down, which then means if we've got a lower net income that we're pulling over to the retained earnings statement, that means retained earnings is going down. So, again, as expenses are increasing, equity is decreasing, so it functions the opposite of the owner's equity. You with me? Okay. You got to think, good question though, because a lot of people go there. So think about what's happening to retained earnings, right? Retained earnings goes up on the right and down on the left. Okay? As revenues increase, you see it? I think she just had the light bulb. As revenues increase, retained earnings increases, so they function the same. As expenses increase, retained earnings goes down, so it functions opposite. So all the increases in expenses are going to go on the debit side. Okay? Dividends, same exact thing, just not exact, similar, okay? But just remember that dividends does not show up on the income statement. The first time you see that is on that retained earnings statement. But as dividends increase, what happens to retained earnings? It goes down. So it functions the same as an expense, or similar to an expense with the debits and credits, but you do not put dividends on an income statement. They go on the retained earnings statement. How we doing? Okay? So again, at this point, now that we're in Chapter 3, hard to believe we're in week 2, right? Just realize these are the 6 basic pieces to the puzzle. Okay? Now, we're going to add a few little minor things to this, okay, as we go on. But if you get these 6 pieces, all those little adaptations that we're going to sort of throw in there shouldn't give you too many problems, okay? So that's going to be your big piece there, all right? Now, again, so notice, going back to this accounting cycle document, okay? The big thing that we are going to do in Chapter 3 is things like this. So, let me divide it up. So in Chapter 2, right, if we had an increase to cash, it also did something with maybe accounts receivable or equipment or notes payable or common stock. Or possibly even a deferred revenue, but we never hit sales and service revenue numbers, okay? So everything in Chapter 2 was all balance sheet. No income statement, no retained earnings statement. Chapter 3 added those 3 pieces, okay? So now, at the end of Chapter 3, we should be good to go on all these different cash increases and what they are for. Now, just as a quick review, again, just think about what's happening here. If cash is going up, that means we collected an accounts receivable. If cash goes up, maybe we sold equipment, buildings, and automobiles. Now, we're going to get to that in detail in chapter 8 or 9. Okay? Notes payable. We took out a loan from the bank. Okay? We have to determine whether it's long-term or short-term, right? Common stock. We issued stock. Collected cash from the stockholders. For the first time, we issued stock. Sales and service revenue. Now we're over in chapter 3. We made a sale and collected cash at the same time. Okay? And then on this deferred revenue, think along the lines of like gift cards. And again, think deferred. Deferred means we put it off. And what we're putting off is getting that cash collection onto the income statement. Hence the name deferred revenue. Okay, so we collect it first, and then we earn it later. So think along something like this. I told you guys in my introduction, my specialty is construction contractors. Okay, one of the craziest vendors that we ever worked with is a company down in Dalton, Georgia that does customized carpeting. And their deal is that, all these, and we did very high-end buildings and things like that uptown where you might have some kind of custom, seal, like, if you've been keeping up with the inauguration, right? They changed out the carpet in the president's office on Monday morning. Changed it from one carpeting to a different carpeting. Well, that is very custom kind of stuff. You can't take that kind of carpet and put it in a different room or use it for anything else. So there's only one company in the whole entire nation that does this, and they're down in Dalton, Georgia. When you order something from them, you have to pay them 50% of the price up front. Deferred revenue. You have to pay them half of it up front. Otherwise, they won't even start the job. Okay? Then, when they finish the job and your carpet is sitting on the dock ready to be shipped, they expect the other 50% before they will even put it onto a truck. Okay? So until they have actually completed your job and got it shipped, that's not revenue to them. Okay? You with me? So those are some of those kinds of things that you can think of when you're thinking of deferred revenue. We collect it first and then we earn it later. Okay? Cash disbursements, right? Yes? No, not a loan, but I get where you're going there. So let's say that I think one of the examples that they used in chapter 2 was we made a loan to an executive that we bought or that we hired from, I want to say like California, and they needed to move to New York, so we gave them a loan to get that move made, and then they're going to pay back the loan. Here's the thing. In a situation like that, we're not earning any of that loan amount, right? That's not something that we normally do. We're just fronting the executive a loan, and then they're paying it back to us, okay? The only thing that we might earn in that is a little bit of interest revenue, okay? But not the loan amount. Make sense? Okay? All right, and number 2, right? These cash disbursements, okay? So maybe we paid cash for equipment. Maybe we paid cash for inventory, supplies, some kind of prepaid asset. We're going to talk more about those here in a little bit. Okay? Maybe we paid down an accounts payable. So maybe we bought something somewhere from somebody else, put it on the tab, and now we're paying for it. Okay? Notes payable. Here, we're actually paying back the principal of the loan. Okay, we'll deal with interest a little bit later. All right, maybe we're paying out dividends. Maybe we're paying for an expense that is occurring at the same time as the cash payment. So something like we went to Office Depot, we bought a toner cartridge that we brought immediately back to the office and threw that in the copier so we could start making copies. Okay, we immediately paid for it and started using it at the same time. Then we're billing customers, right? Then we just got to decide again, our customer came in and said, put it on my tab, okay, and we're sending them the bill, okay. Then the recording invoices from vendors. So now we said put it on our tab. Now it's a question of what did we buy? Did we buy some kind of asset like equipment, buildings, or automobiles? Did we buy some kind of inventory? Did we buy supplies? Is it some kind of expense? Now understand that when that makes it look easy because I've just got expenses there, but there could be like 15 different kinds of expense, but it's an expense, okay? So make sure that you're just kind of there. These 4 items are all we're doing in chapters 2 and 3. Don't make it harder, okay? So let's go over and let's start from here. If we want to get over, for you to get over to the Connect, let me just say that the easiest way I think to do that is just come over here, click on Smart Book. It'll take you over. Click out of the Smart Book assignment, because where it's going to take you is, tell it that you want, I think you tell it that you want to go to the home page, because then at that point where it takes you is right here, okay? And Smart Book is a really good one to use on that one, because if you accidentally start it, it is not a problem. Don't click on a quiz and, homework. Just keep in mind that you've only got 3 attempts. You can hit save and exit as many times as you want to, but just not submit. Okay? Now, a couple other things that I want to note here, since we're all kind of getting used to all the technology and everything. Just realize right here, you do have a little quiz app that you can download to, your phone or whatever, and go in and practice on some of these things. Because again, remember, we learn a lot of vocabulary in accounting class, as well as understanding how to use the numbers. Okay? All right, so right here on Chapter 3 assignments, first of all, when I tell you to, when I've told you to how to approach a chapter, what I mean is that first thing of, doing some reading and reviewing the chapter, these demonstration cases are really excellent because it is a problem that takes you through every single aspect of what you just learned in the chapter and really kind of boils it down to the necessities, all right? So don't skip that. If you need additional help, lab work is a good one. Current events, that is absolutely optional, whether you want to do it. And then again, static exercises and static problems are where we're going to live in class, okay? All right, so let me ask this one question here real quick while I'm thinking about it. Has everybody found the YouTube channel? Everybody's got the link and everybody's good there on watching the videos and everything? Okay, all right, excellent. All right, so let's start with the static problems. Okay, now if you notice in the static problems, the first thing that we're going to start with is a continuing case. And that continuing case is a lady named Nicole, and she is starting a spa. Okay, so at this point, she's got her spa up and going, and now things are actually in progress of functioning. Okay, so her business is actually bringing in customers, etc. Okay, so let's take a look. So we've got starting in May, Nicole has decided that she has everything she needs to open her doors to customers. To keep up with competition, Nicole has added gift certificates and has started to advertise her company more to keep her business going in the long term. Here is a sample of some transactions that occurred in the month of May at Nicole's Getaway Spa. Now, couple of notes here. Couple of things. Don't start reading through all this data, okay? For one simple reason. You don't know what they want you to do with it, okay? So, when you see all these transactions, just skip over them for the moment, okay? Let's come down here to the item. So it says for each of the transactions, prepare journal entries using the date of the transaction as the reference. Okay? All right. Now, keep a couple of things to note. Here's your journal entry worksheet. Most of the time, like a good 98% of the time, you have everything that you need right there in that box, right above where they want you to key in the journal entry. Okay? If you're looking at that information and you're like, I don't think I have enough, just scroll back up to the top. Sometimes there's some little detail or something up there in the top in the narrative that they don't put down here into the question. All right? So let's start running through some of these. All right? So item number 1 says record the payment of $3,000 cash for an insurance policy that covers the period from June 1 until May 31st. Now, couple of things to note here. This is where some of this kind of stuff absolutely drives you, big picture folks, absolutely nuts, because this is where detail matters. Okay? So, couple of things. Let's talk about how an insurance policy works, first of all. So when you're buying insurance, whether it be personal or business, typically what happens there is you pay for the insurance first, and then you start using it up. Okay? Now, most of the time and let's just make it on a personal level, most of the time for personal insurance, let's think car insurance, you pay that premium 6 months in advance, and then over the next 6 months you use it up, and then you got to make another payment, and then you start using up that insurance over the next 6 months, because the insurance company has provided you with access to insurance coverage. With me? So, couple of things to note here. When we're the purchaser of the insurance, notice that the date that this transaction is occurring is May 1st. All right? When does this insurance start? June 1st. Okay? So, couple of things to note here. One, we've got a cash payment going out, right? So, down here on the second line, let's just give me a little cat. Oop, how about I spelled correctly? We've got cash, and also notice there, I did not hit the down arrow. If you do that and start doing all that scrolling and everything, personally, I think that just makes things more confusing. So, if you need cash, just type in CA. It'll start shortening things up, and then you can just choose cash there, all right? We know that cash went down. Cash goes down as an asset, so it goes down on the right-hand side. So we got $3,000. Now, at that point, remember, sometimes it's better to be lucky than good, okay? In this particular situation right now, we've got, I'll just give this part away, we've got 4 things that we're looking for this journal entry, okay? If we've got 2, our grade is now a 50, okay? If we get one more item, we go from failing to passing with a C. You with me? Okay? Now, you know one thing about a journal entry, hopefully you've gotten this on your own so far, is they have to balance, right? So if I go from this to that, I just went from failing to a C. The whole point here is this. It's better to be lucky than good. If you just can't think of what that other account is, don't leave the whole entire line blank. You know that the journal entry has to balance. Go ahead and plug a number in. Now you're up in the passing zone. Okay? All right? Now, what's the other account? Prepaid insurance. Good. So, if I can type. So I just type in prepaid. There we go. So we've got 3 prepaid items that we can look at here. Okay? We're going to choose insurance, but again, I want you to see how all of these things are working. Whether it be advertising, insurance, or rent, in business, we typically have to pay for those items before we use them. Okay? So we pay for insurance and we start using it up. We pay rent at the beginning of the month and use it up. We pay for advertising, because remember, advertising is a custom type item. So again, like that carpet, it's like we have to pay for the advertising first, then it gets put into the newspaper, then it gets put on the billboard, then it gets put into the magazine. You with me? Put on the website. Okay? So all 3 of these items work pretty much the same. You pay for them first, then you use them up. Okay? In this case, it happens to be insurance. Okay? So now, note what happened. We just moved one cash item into another kind of asset. Okay? Remember that I told you last week, you've got to learn to recognize patterns. And that's all we just did here, is we turned cash into some other kind of asset. Okay? Let's get number 2. Record the entry for the order placed for 5 new massage tables from Spa Supplies Unlimited for $250 each for future delivery. Okay? Now, that's a lot of words to say that we picked up the phone, we called Spa Supplies Unlimited, and we placed an order for 5 new massage tables. You what? Beautiful. No journal entry. Okay? Now, be honest. How many of you wanted to put something in there? Okay. All right. Now, let's talk about why there's nothing there. Okay? Because again, the first question you have to answer. Okay? We're constantly going to try to, sorry about this, trip you up. Okay? Or not necessarily trip you up, but we're trying to get you to think deeper, to think, is there something that's happening in the accounting department? Okay? Now understand, is there something happening within the company with this? Yes. The purchasing department picked up the phone, called the company, and said, we need a couple of massage tables, and they said, okay, great. Okay? When will this affect the accounting department? Okay, good. Okay, one of 2 things. So you both are correct. One, if a payment gets made, okay, so maybe they call us and say, okay, your massage tables are ready, but we need a check. Okay? Or the massage tables show up on the shipping dock. You with me? Because at that point, now something's happening in the accounting department. Before that, all of this was happening over in the purchasing department. Okay? All right, number 3. Record the entry for $860 worth of spa services provided to customers on account. Okay? Now, again, try to picture what's happening here. Don't get all hung up in the verbiage. Customers showed up. We gave them massages, okay, or spa services, and they said, put it on my tab. Okay? So they now owe us for those spa services, and we provided those spa services, right? Okay? So let's look at this journal entry a little bit differently. How many accounts are being affected? 2. Now, if that's all we can figure out in this question, look what happens. We got 50% of the points. Couldn't think of what the accounts were or anything else, but we got 50% of the points. Don't leave things blank. Okay? Now, so what are the two accounts that are affected? Good. Accounts receivable and service revenue. So accounts receivable, I'm just typing in ACC, right? That's going to get the debit because, again, now we've got an asset that somebody owes us. So that's going to be received later. And service revenue. Okay? Now, remember that we've got to determine what type of revenue it is. In this particular case, it's service revenue. And how do we know that? It's not necessarily about it being earned. What's the word in the statement that tells you that it's service revenue? It says that we sold services, right? Because maybe we did somebody's nails, maybe we gave a facial, maybe it was some kind of mud bath or something. Who knows, right? But if it said that we sold, spa supplies to them. I don't like that word, but anyway. But maybe somebody came in, got a manicure, really loved that nail color, and decided to buy a bottle of that nail color. Does that go under service revenue? That's sales revenue. Okay? All right. Number 4. Record the receipt of spa supplies purchased for $800 on account to use at Nicole's Getaway Spa. Now, again, try to imagine what's really happening here. When we are buying spa supplies, think along the lines of things like large bottles of lotion that they might use for, afterwards for, a hand massage or something. Massage oils. Some kind of essential oils or something. I actually had a spa service one time where they put flower petals all over everywhere. So flower petals, okay? So understand what's happening here is that these supplies are things that they buy and they're probably just going to use them up, and they're just sort of a secondary element, if you want to think of it, to being able to supply that service, okay? Because let me just tell you, if you've never had a massage, you don't want somebody rubbing on you without massage oils. That's going to hurt. That's not going to feel good. All right, so how many accounts are being affected here? 2. So let's give me 800. Oops, and don't do that. Let me just say that it's like that happens all the time with keying something in incorrectly. All right, what are the 2 items? Okay, we bought supplies, so it's going to get a debit or credit. Good, it's going to get the debit. So I'm just typing SUPP. Now again, a couple of things to note here. Is it supplies or supplies expense? It's supplies. Why? Good. It's not used yet. We just bought them, brought them back to the business, and put them in the supply closet. Okay? So it's going to be supplies. Once we use them, then it becomes an expense. Okay? And the credit's going to go to good, accounts payable. Because we said put it on our tab, or we bought it on account. Okay? All right? Number 5. Record the receipt of a bill for $60 for running an advertisement in the newspaper in May. Now notice a couple of things here. It is May 13th. It went in the newspaper in May. This is not typical, by the way. How many accounts are being affected? 2. So give me a 60 and a 60. Okay. We now owe somebody for that advertisement, so It's accounts payable, because all it says is we received the bill. And the debit goes to what kind of advertising? Good, because look what happens. If we just type in ADV for advertising, we're going to get expense and we're going to get prepaid. Why is this one expense? Good, it happened in the same month, so it's going to be advertising expense. If it was prepaid advertising, this other account would have to be cash, right? And the advertisement hadn't gone into the newspaper or anything yet. Yes? Because right here it just simply says we record the receipt of a bill. No. It doesn't say any. Oh, it does. Excuse me. Goodness gracious. See? We did a couple of things there. We actually did 2 steps there. My bad. I was totally skipping over the whole bill was paid in cash. So on this one, it would be cash. But here's the thing. 99% of the time, this is actually 2 steps. If we just received the bill, it would be accounts payable, then we would pay it later. This one, we received the bill and we paid it on the same day. Okay? Now, there's also another assumption here that kind of makes this one a little wonky, is that once it, how can I say this? The moment that we would record the accounts payable, real world, would not necessarily be when we receive the bill. It's when the advertisement shows up in the magazine, the newspaper, on the billboard, etc. This one right here is a little bit weird in the way that they handle it. Because again, advertising 99% of the time, they're not going to run that advertising because it's custom work. And if you think about this, this is the way that the real world works. They're not going to run that until they get paid. They don't want to do the work, and then you go, oh, well, we didn't like the way that looked or something. It's like, no, you agreed to it, and you approved the print, and so you're not going to get advertising until you pay for it. So this one runs a little funky. All right. Number 6, record the payment of 1/4 of the amount owed from May 10th. Well, now we got to go back to May 10th. Okay. May 10th, let's see, was this one. Okay. So first of all, we've got to record 1/4 of that amount, which is $200, right? So 800 divided by 4. Okay, so 200 is the amount of the journal entry. Okay, we recorded a payment, so cash is going down with a credit, and good. Accounts payable is going down. Okay, so now try to think ahead. Right now, what's the balance in accounts payable for this particular flow of information? $600. Okay. All right. Number 7. Record the payment by customers of $1,900 cash for Nicole's Getaway Spa gift cards. No gift cards have been used. Okay. So, let's start with cash is going up. So it's like, I came into your business, I'm your customer, you are Nicole's Getaway Spa. I came in, gave you $1,900, and you basically handed me a whole bunch of gift cards. Okay? All right? So cash is going up for $1,900. How many more accounts are being affected? 1. So go ahead and give me a $1,900 there. And what is it? Okay, we got sales and deferred. Now let's make the distinction between the two. Remember, if it were sales revenues, those gift cards would have had to have been used. Okay, so right now, the only thing that has happened, now, and let me just say this, a lot of times what y'all want to do is y'all will want to think all the way to the end of the transaction, but you have to look at just what's happening today. And the only thing that happened today was the collection of the $1,900, and we've got the deferred revenue. Now, when those gift cards get used, what happens? Let's word that a little bit differently, though. Hang on. When the gift cards get used, no more cash is being affected. It comes out of the deferred revenue and goes into service revenue. Or it could go into sales revenue depending on what they buy with the gift card. You with me? Okay. So don't bring any of that information that's going to happen in the future. Don't bring that back into today. Okay. All right. Number 8. Record the entry for financing obtained from the bank by signing a $5,000 2-year note payable. The $5,000 cash was deposited into Nicole's Getaway Spa bank account. So cash is going up with a debit. Good. Okay. All right. How many more accounts are being affected? 1. So go ahead and give me a credit of $5,000. What is that account? Good. Notes payable long term. Okay. And what made you choose long term? Good. It's over a year. Okay. Number 9. Record the receipt of 2 of this massage tables ordered on May 4th and paid for the 2 tables in cash. Okay, good. Good. Well, yes. Okay. Again, I'm always sitting there and I'm thinking, I don't really like the way this works because, again, this is not real world. This is more, think more along the lines of they brought 2 massage tables, dropped them off, and said, I'm going to need a check before I leave. That's what's really happening here. Okay? That wouldn't be real world. Okay? All right. Now, we've got the equipment. We've got the cash. How much? How much? How do you know? Yeah, they were $250 each. And again, this is going to be one of those things where it's like you might have read that and went, I don't think I have enough information, but here's the deal. Right here in item number 2, record the entry for the orders placed for 5 new massage tables, unlimited, for $250 each. Okay, so you're going to have to pull that information forward, and it's $500 and $500. Okay. Number 10. Record the payment of $500 cash for utility bills for services received and billed in May. Okay. Now, couple of things to note here is this. What is really happening here is we came in, we flipped on the lights all month long. We're using electricity. Duke Power is, providing us electricity. And at the end of the month, they said, here's your bill. Maybe they emailed it to us, and we immediately sent the cash back to settle up the bill for the month. Okay? Again, not really realistic, but it could happen. All right? So, we know it's 500, so give me a 500 and a 500. Okay? Cash is going down with a credit. And good. Utilities expense, because it was because it says for utility bills for services received and billed in May. Okay? In Chapter 4, that's going to change. All right? Now, if we click on View General Journal, a couple of things to note here is this. When we do something like this, a lot of times the next step that we're going to have to do is we're going to have to post all these journal entries into the general ledger. So in my world, I'm going to try to get this all on the same page, which right now my computer doesn't want to do because it doesn't want to get any smaller. All right, fine. My scrolling is being very squirrely lately. All right. Well, I can't get it all on the same screen. You can probably get it on the same screen. I come down here again. Remember, now, sorry for you Mac users. I don't know what it's called in Mac. I'm sure there's something called this, but pick up the snipping tool. Once you're click New, your mouse turns to crosshairs, and just come back over here and pick up all those journal entries. And then throw this to one side. I like to have the fixed information on the left, and then anything that I'm actually keying in on the right. You could be different, but that's just the way that I like to do it. Okay? And that's the easiest way to get all that over. And then again, we practiced posting the other day, but just come back over here, and as you post it, just, you can do it in order, right? Coming down. You can do it that way, or you can come over here and you can say, okay, I want everything that had to do with cash. So there's a cash, there's a cash, there's a cash, there's a there's a cash, and there's a cash. Either way you want to do it is fine. It comes up with the same answer and the correct answer, so it's all good. Okay? Any questions there? Okay? Now, here's the great thing about all of this. If you're sitting there thinking, sweet mercy, it's like accounting is so boring. Understand, we all got that many years ago when we had to do all this manually. We were one of the ones, the accounting industry, we got some of the first software because we knew that all of this, number one, was very tedious and very boring. The other thing is there's way too many opportunities for errors. Once we implemented software, then we got more accurate information without all the errors. Okay. Now, a couple of things to note here. One, it says, calculate Nicole's Getaway Spa preliminary net income and net profit margin for the month. All right. So the preliminary net income is a dollar amount, revenues minus expenses. And then the net profit margin, you remember how to get net profit margin? It's net income. Good. Net income divided by revenue to get your percent of what percentage is left over after every dollar of sales. Okay? All right. So when we're looking at this preliminary net income, I should have left the other snippet in place. But when we're looking for all of that, we're simply going to come back over here and we're going to look at all these items, and we're going to pick up this revenue item right here of the $860. We're going to subtract the $60 in advertising expense, and we're going to subtract the $500 in utilities. So if we take the $860 minus 60, now we're at 800, minus the 500, we've got 300 in net income. You with me? Now, we had to do that from the journal entries, but understand, when we keyed all these journal entries in to the computer system, right, it would have automatically posted everything out there to all these accounts, and we would have really been pulling all that information out of the T accounts or the general ledger. We would have looked at what's the balance in revenue. Well, it would have been $860. What's the balance in any of the expenses? Well, we would have had $60 in advertising expense and $500 in utilities expense. Okay, we wouldn't have to go all the way back to the journal entries. Okay, So we've got 300 there, okay? The net profit margin is the 300 divided by not 60. 300 divided by 860, okay? So notice what we get here. We get a 0.3488. Notice a couple of things. It says round the net profit margin to 1 decimal place. So keep in mind that you're not going to key that in as a 0.3 because look, you've got a percentage sign right here. So move that decimal place 2 places. That gives us a 34.88, which would be keyed in to 1 decimal place as 34.9. Okay. How we doing? Okay. So that basically tells us out of every dollar that we have in sales, we're ultimately going to keep about 35 cents. Now that's unadjusted or preliminary net income. Okay. All right. Hit the next. And number 3 says, which of the following best describes the adjustments that will have to be made before the income statement is finalized? Now, again, look at, hang on. Let's go back. We're skipping, so don't get confused. We are skipping one major item here, and that is the posting into the T accounts. So think about what's happening here. If we needed adjustments, let's look at each one of these journal entries. Will prepaid insurance need any kind of adjustment? Not for May, but when will we see the first adjustment for the prepaid? June, because the policy starts June 1, right? So we won't have an adjustment for that in May because we haven't used anything. We haven't been offered any kind of insurance coverage. But come June 1, we'll have to move prepaid insurance, a little bit out of prepaid insurance into insurance expense. Okay. Let's see. Supplies. Any adjustments there? Good. When we start using them, then we figure out, okay, how much do we need to make an adjustment for? We'll do that in Chapter 4. Okay, so this whole conversation right now is really sort of a little bit of foreshadowing for Chapter 4. All right, advertising expense is fine. What about deferred revenue? Good. When they use the gift cards, we got to get it out of deferred revenue into that earned revenue, whether it be sales or service, depending on what they buy. Let's see. Equipment. We're going to see that one later. I don't want to address that one at the moment. And then utilities expense, we're good to go. So does everybody see why we would have to have adjustments? And again, remember, in the accounting department, the 4 big things that we're doing every day: collecting cash, making payments, billing customers, recording invoices from vendors. These adjustments have to be kind of a end of the month kind of process because there's no functionality built in the accounting process on a daily basis to get these things recorded. Okay? So we would stop at the end of the month and go, you know, we've got a $3,000 prepaid insurance balance sitting out there. Does that need to be adjusted? Have we used any of that insurance? At the end of May, the answer would be no. In the June, it's yes. Okay. All right. So when we get over here to this one, so which of the following best describes? Record supplies used up in May. We actually addressed that one. Record income taxes on May's net income. That one we would also have to do as well. So it is all of these. So keep in mind that the last journal entry that we make every single month is for taxes. Do we owe anything to the federal government? Do we owe anything to the state government? You know, do we have international income that, you know, we owe their taxing? Okay. How we doing? All right. Okay. Now, this next one, this is one where we take a look at the financial statements of Home Depot. They give us a little blurb of Home Depot. But what I want you to do is, when we're looking at this, I'd rather look at Lowe's. Okay? So, let's open up a web browser. Okay? And I'm just going to type in Lowe's.com because I like Lowe's better. And part of the reason why I like Lowe's is because they're a North Carolina company. Did you realize that? Their headquarters is in Mooresville. Okay? So, if we want to look at financial statements for Lowe's, because we're not going to do any shopping today, where would we find that? It's usually way down here at the bottom of the screen, where you always completely ignore all this stuff down here. Okay? So notice what happens here. We have all this information down here that most of the time, it's like it's right out there when we're dealing with a retailer. It's right out there, and, you know, it's all there for everybody to see. So you got a couple of things here. We got, you know, who are we, careers, our responsibilities, investors. We've got newsroom. That could be a possibility. Lowe's suppliers. So, you know, if the Lowe's suppliers need something, they can click there, right? Safety. Lowe's creditors, right? Lowe's brands, Lowe's marketplace. Now, the one that we're going to look at is right here called investors. Okay. And again, most every company that's out there, from their homepage all the way down at the bottom, will have something like an investors or financials or something along those lines that you can click on. Okay. So look at this one. We've got the 2024 Analyst and Investor Conference. Okay. Little stock price information. We've got quarterly earnings. We've got a little investor toolkit. We've got financial news, the annual meeting, all kinds of good stuff there. What is our strategy? And then right here, notice it's like that is particularly the 2023 annual report. Now, right, hang on, okay, here's all the information here, right? We've got investor conferences, 10Ks and proxies. Just realize that that's like, you know, from the Securities and Exchange Commission. Latest earnings press releases, 10-year financial information, fact sheets, you know, stores by state, U.S. sales by product category, all that kind of good stuff, okay? So there's all kinds of things out here that you can take a look at. When we come up here, they're constantly moving this around on me. Sorry about that. All right, so to get to the financial statements, I just came up here to investors. Right here under financial information is the annual reports and proxy statements. So a couple of things to note here. We've got all years. All right, we've got annual reports, and they go way back all the way. I'm going to go to last. And the first set of financial statements that Lowe's came out with was in 1962. Okay, so in this one, I'm going to download that one, and we're going to compare that to the most current. All right, now notice that 2023 is the last one that we've got. So I'm going to sort of separate these. I'm going to pull that one down, throw that to one side, and put the 1962 report on the other. Okay. Now, a couple of things that I want you to see here is look up there at the top. Okay? Their 1962 financial statements were 20 pages. 2023 was 103. Okay? Couple of things to note here on, again, so much of this is more marketing type materials. This is the CEO. He just looks like the nicest guy. He came from JCPenney. Let's see. Keep rolling. And there is his letter to the investors and everybody, right? Dear shareholders. So his little letter is like 3 pages with some pictures. Okay. Total home strategy. So here's the 2023 highlights. So again, a lot of this is marketing materials. So little financial highlights. 86 billion in sales. Pretty cool. Operating margin, 13.4%. Diluted earnings per share. Okay. Return on invested capital, 36%. That's pretty good. Okay, here's our Form 10K. Again, that is a report that goes to the Securities and Exchange Commission. Okay. And then we get this list right here, okay, of the table of contents. So I want you to look at this table of contents here. Right here, right there, item number 8 says financial statements and supplementary data. Notice that starts on page 34 and item 9 is starting on page 68. Okay, so click right there on those financial statements. The financial statements, let's get to the top of the numbers. That link didn't really work very well. All right, let's see. Well, here we go. Here we go. So really, I don't know why that link didn't get you to the right spot, but it didn't. So a couple of things that I want to point out is if you scroll to what is showing on this page 38, this is, notice, the report of the independent registered public accounting firm. So if you're thinking about an accounting career, starting off in public accounting is a really good way to go because you get your you sit for the CPA exam, get your CPA license, and that tells everybody that you know what you're doing. So this page right here basically makes this whole entire 103 pages valid. Somebody else came in, looked at the numbers, and said, everything looks pretty good. Okay? And this is the information that the auditor put out. Now, I'm not going to read all of this to you, but there is one sentence in this. So notice, 1, there's an opinion on internal controls over financial reporting. So they've looked at the internal controls and said, it looks good. They've got processes in place that will get them accurate information. The basis for the opinion, they tell us what they did. And then the definition and limitations of internal controls over financial reporting. So, let's see. So then they give us a little bit of information there. Now, this says, though, ooh, interesting. Because of its inherent limitations, internal control over financial reporting may not prevent or detect misstatements. Also, projections of any evaluation of effectiveness to future periods are subject to the risk that controls may become inadequate because of changes in conditions or that the degree of compliance with the policies or procedures may deteriorate. That's not a good indication that Lowe's internal controls are effectively in place. Okay, because remember, internal controls are those processes and checkpoints which indicate that all revenues are going to be recorded at the correct amount. All expenses are going to be recorded at the correct amount. So Lowe's is starting to have some problems here. Now, anybody been to Lowe's lately? Okay. What big change have they made at the checkout? The self-checkout. I mean, it's like every Lowe's that I have been to recently, it's like they might have 1 or 2 checkout lines that are actually manned with a person. The rest of it is self-checkout, but they don't seem to be looking real closely at folks when they are doing that. So on some level, to me, it's like probably a little more training at that point would be a good one. A couple other things to note here is Deloitte Touche is their public accounting firm that did the audit. They are out of Charlotte, North Carolina. Okay? Then you've got the consolidated statement of earnings. You've got the consolidated statement of comprehensive income. We get into that in intermediate accounting, but just think income statement. Okay? Then you've got the balance sheet. Then you've got consolidated statement of shareholders' equity. So instead of this just being the retained earnings statement, it's all the different elements of shareholders' equity. And again, we get into that in intermediate accounting. And then you've got the statement of cash flows. Okay? So I want you to notice that out of those 103 pages, there's really 1, income statement, 2, balance sheet, 3, statement of equity, and 4, statement of cash flows. There's only 4 pages of numbers out of those 103. Okay? Now, look at 1962. Okay? 1962, I think the pictures are just hysterical. Okay? All these old technology and everything else. Okay? Now, look at a couple of things here. We've got the consolidated statement of earnings and retained earnings. So there is like a half a page of an income statement versus a full page. Here's the retained earnings statement. That's about, a third of a page rather than a whole page. Here is the balance sheet. So basically 1 whole page versus, actually they put it on 2 pages rather than 1 page. A couple other things to note is here in 1962, there's only 2 columns of information rather than 3 over here currently. Okay, and then a little bit of a 5-year review. Now, a couple of things to note. Why would these financial statements look so different? Well, the complexity of the business definitely has increased. Accounting policy, standards, procedures, and everything else have also changed. Disclosures. Because here's the other thing. Look at 1962. Keep scrolling at the end of these right here. It says notes to the financial statements. We've got a half a page. Go over here to the left. We start with note 1, starting on page 43, and it goes to page 68, which they said was the next bit of information. So every bit of this is notes to the financial statements. So you got 4 pages of numbers, and you've got, 27 pages of notes versus a half a page of notes. So again, the big thing that changed between 62 and 2023 is accounting standards have changed. Okay? So a couple of things that I just want to point a few of those things out. One significant thing that I want to point out is this. That first note to the financial statement, if I can get back to it, notice that that first note to the financial statement in 2023 says notes to consolidated financial statements years ended February 2024, 23, and 22. So notice what's happening there. Note 1 says summary of significant accounting policies. Every set of financial statements has to start with that note because they're going to tell us all kinds of things like fiscal year. The company's fiscal year ends on Friday nearest the end of January. That's a little weird. That's not typical. Usually it's like January 31st would be the year end. So apparently they go from like beginning of February to end of January-ish, give or take. So those actual dates would change from year to year. So notice that it goes from February 2nd one year, February 3rd to the next, and January 28th in the previous year. So their year end does not end on the same date. That's a little odd, but normally it's a month end, like it's always going to be January 31st kind of thing. Okay, theirs doesn't work that way. Foreign currency, they tell us a little bit about what they do with foreign currency, how they're using estimates, what they're including in cash and cash equivalents. We'll get into that in Chapter 5. Investments, we won't really get into investments. We'll get into more long-term asset kind of things. Investments we hit in intermediate. They tell us all about their inventory procedures and policies. They've got all kinds of information down here about derivatives, credit programs for their business accounts, property and depreciation. So every bit of that is going to tell you a whole lot. So I know that for some of you in Business 110, you probably looked at just the numbers. But here's the thing. You cannot effectively interpret a set of financial statements unless you're reading the notes to the financial statements. Okay? So there's a little bit of comparison with Lowe's. All right. So this is a good spot for a break. So let's be back in here at 11.